market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, after months of interviews and speculation, President Trump has said he will announce his pick for Fed chair later today. Bloomberg understands that the Trump administration is preparing to nominate former Fed Governor Kevin Warsh. Now, he would succeed Jay Powell, who has repeatedly been attacked by the president for not cutting rates faster. Well, let's bring in Bloomberg's senior editor, Alistair Bull. Alistair, thank you for joining us. So President Trump has been searching for a unicorn candidate, a loyalist who'll cut rates, command credibility on Wall Street, but also within the president's MAGA base, and get past the Senate confirmation. Does Kevin Warsh tick all of those boxes?
Yes, actually, he probably does. But I think the first thing to say is he's actually a very orthodox choice for Fed chair. He served on the board of governors, he worked on Wall Street, he's a trained lawyer, he's been around finance most of his professional career. So in normal times, this would not be a controversial pick, but these aren't normal times. So Kevin Warsh, if nominated, is going to face intense questions about his readiness to defend the independence of the central bank, which has been under assault from the Trump administration. And I think the first point to make is, should President Trump nominate Kevin Warsh, that nomination will go no further than the Senate Banking Committee until an open investigation from the DOJ, the Department of Justice, into Fed Chair Jerome Powell is resolved, because senior senator on the Republican side on the Senate Banking Committee, Tom Tillis, has said he will block it until that investigation is put to one side. Francine.
Alistair, thanks so much. Bloomberg senior editor Alistair Bull. I mean, this, without a doubt, is the story of the day. But Apple has also delivered record quarterly profit and a better-than-expected forecast, driven by strong demand for the iPhone 17. But it's also warned that rising costs could eat into margins. Let's bring in Neil Camplin, Bloomberg senior strategist. Neil, thank you for joining us again today. So iPhone sales, a highlight for Apple, but there were also some weak spots.
To be honest, I think if we take a step back, let's look at the facts. The facts were, as you mentioned, record iPhone quarter. They also delivered the fastest revenue growth quarter for 16 quarters. They've guided the March quarter on the top line to grow 13 to 16%, representing the best March since 2021. Gross margins in the quarter were very stellar. And actually, if we look at the midpoint of guidance, they're guiding to higher gross margins in the following quarter. The concerns that people are talking about were raised on the conference call, and this relates to memory and component pricing. Now, for Apple itself, actually, it probably has the greatest pricing power of any company on this planet, I would argue. And actually, it is us as consumers that are likely to wear that cost increase if it comes through, as we'll see the increase of the iPhones in future cycles. So I think, Apple only guide one quarter at a time, and are actually guided to a really robust set of results. Now, the price action after hours is actually in line with what we've seen historically. Apple actually only moves on average by 3% the day after earnings. It isn't typically a volatile print, in contrast to what we've seen with some of the other Mag 7 stocks on recent numbers, yesterday being a very good case in point. But it's that memory focus that people are worried about.
Yeah, and I mean, we're also hearing through our own reporting that Elon Musk may be trying to consolidate his tech empire. Like, what options does he have?
Yeah, I think it's very interesting, actually, that obviously Bloomberg's reported a number of times about a potential IPO of SpaceX. And now we're seeing stories about sort of end of life cycle for some of the Tesla core products historically, such as the very old now Model S. It's been 12 years in production. And if you think about it, we're talking about potentially a SpaceX valuation of $1.5 trillion. If that was folded into Tesla, you'd be looking at a market cap of around about nearly basically doubling the size of Tesla, $3 trillion, which obviously would put it right up there in the top 5-6 companies in terms of the US market cap within the S&P 500. And if you sort of fold in XAI as well, which I think it's much more difficult to get financials around that particular business. But certainly the idea of Tesla morphing into sort of a more complete tech company rather than purely based on the EV cycle kind of makes strategic sense. And I think from investors I've spoken to, would be a welcome development for the Musk empire.
Neil, thank you so much. Our Bloomberg senior strategist there, Neil Campling. Now, gold retreating, the dollar gaining on reports that Kevin Warsh will be the Trump administration's pick to replace Jay Powell as Fed chair. Well, joining us now to discuss all of this, Will Kennedy, Bloomberg EMEA news director, and Subitha Subramaniam, Sarasin Partners head of investment strategy. So thank you both. Quite a lot going on with gold. Well, we'll get to that in a second. But Subitha, overall, I mean, Kevin Warsh is kind of repricing the markets a touch. Is it just because they were too exuberant expecting these cuts?
So, I mean, I would say Kevin Warsh is an intellectual heavyweight, and it's in many ways an unpredictable choice. I understand that he has an orthodox history, and at the time that he was at the Fed, say from 2006 to 2011, he had a hawkish tilt to what he believed in. He did dissent quite actively, and he actually left the Fed after he dissented when he believed that they had done QE2, and he did not agree with an expanded Fed balance sheet. So he comes from a very orthodox history, subscribing quite actively to Milton Friedman. I think the challenge now here is that he has, in more recent days, actually argued quite forcefully for lower interest rates, because he is taking the line that Governor Myron has, which is that the economy is undergoing a profound AI transition, and actually inflation is going to be much lower. So it's quite unclear, actually, what he will do once he is elected as Fed chair.
But, Subitha, I mean, is there a sense that he just aligned with what President Trump wants?
It's really difficult to know, because he is actually quite an intellectual heavyweight, and he has actually, in terms of just the members of the FOMC, he will have a lot of credibility. He has disruptive views. And what's interesting is that he is taking a position on AI. So he's using some sort of fundamental underpinning to say that I actually believe the structure of interest rates should be lower because of what we're undergoing. I think the challenge for him will not just be in terms of what, cutting interest rates, also whether he can lead the rest of the FOMC, who I believe is quite very much sort of slightly offended by sort of the persistent political pressure. And can he actually garner and bring the rest of the FOMC with him? Because he will need to do that.
Yeah, we'll get back to Fed in a second, but Will, I mean, the big story, of course, of what we've seen in copper, what we've seen in silver and gold has been absolutely extraordinary, just also by the sheer amount of volume trading. I mean, is that away from dollar? Is it away from an asset? Like, what kind of play are these?
Yes, it's a combination of things. If we take gold first, it clearly is partly driven by people's desire to diversify away from dollar assets. It's being driven partly by central bank buying, and we've seen quite significant buying from banks, including the Polish Central Bank, Brazil, China especially. And I think, in this uncertain world, in the geopolitical uncertainty we have, I think a lot of central banks take the view that they want to be less concentrated on the dollar. So that's certainly a macro trend, and it's being supported by a lot of retail interest in gold, again from China. There's been a lot of interest in metals investments in China, which again is driven by some of the same concerns and trends, and you put those things together and there has been this huge move in the gold price, and even after the correction today, we're still up 18% this year, 81% over the last 12 months. These are extraordinary moves in the precious metal markets.
Yes, so this is a move away from risk, I guess, right? It's kind of like the ultimate safe haven. What risks are you seeing out there, Subitha?
So I would say, stripping everything back, what we have today is, I'd say the biggest risk is the unsustainable fiscal trajectory for the world economy. Yeah. And that's what gold is.
That no one's paying attention to.
That no one cares about, actually. So gold is really reflecting the fact that there is no government here who is trying to actually balance the books for the long term. So gold is basically saying that actually we will have, really realized inflation over the next decade or two. That's just going to be much higher. And people don't seem to really care for that. And so I'd say, we have populist pressures to increase government spending, populist pressure to cut taxes, government spending just really not constrained. And so I would say beyond the geopolitical risks and the fragmentation of the world economy, I think gold reflects as well just a question over fiat currencies. Yeah,
but going back to geopolitical risks, global supply chain risks are back on the table. We'd completely forgotten about it in December. It was kind of like a story of, mid-2025. Are you worried that 2026 they come back with a vengeance? And that, again, has huge implications for inflation and fiscal.
Yes. So I would say that, the whole sort of geopolitical sort of drift that we're experiencing, the whole fragmentation of the world economy, I'd say Mark Carney's speech really laid that bare in terms of just saying that actually the world has changed. Supply chains will now fragment and be much more localized for security reasons, and that will lead to higher inflation. It's not clear whether that will happen in 2026, but I would say with fair amount of confidence that by 2030, we are likely to see much higher levels of inflation coming from supply chains and inflation volatility.
And do you see that playing out on the commodities more than anything else, or are we going to see these supply chains being tested everywhere?
I mean, let's talk about copper, which is a key input into many industries and many economies. China takes half the world's copper, so it's incredibly key to their economy. And it's at record prices. It hit more than 14,000, and there are many people who think it go higher. Obviously, a weaker dollar is supportive of commodities, but this is really driven by fundamental supply and demand. The fact that copper supply is not as strong as it has been, and that demand is being driven by many of the industrial trends that we've seen, whether that's the electrification of the power grid, the move to EVs, the construction of data centers. These are all supportive for copper. So many people think prices will continue to stay elevated, and of course that will have an inflationary impact.
But Subitha, to your point about fiscal, are you expecting like a big market event or something going wrong, or do countries realize before something ugly happens?
I think we just have fiscal deterioration gradually, and no one cares, and then one day we will wake up and worry about it. So if you think about where we are today, we have a world economy that's growing fairly robustly, and we have fiscal stimulus coming in the US, in Japan, in Germany, and even in the UK, because we have restraint only later on in the future years. So we have a fiscal stimulus across the developed world at a time when the world is growing fairly robustly. So I would say that, it just continues to tick up. Fiscal risks continue to tick up. And then one day, I would say that at some point in the future, when debt to GDP ratio, it's very difficult to predict when we all start to care.
But is this more, the Germany spending is definitely linked to defense. So should we look at war economies and see perils through that, or do you think this goes back to COVID?
I think it's sort of the lesson from COVID is that governments became really comfortable spending because they had a reason to spend, and they really became comfortable sort of expanding the footprint in the economy. And I think that's the lesson that we've got. And that's now been amplified with more populist pressures across these economies. In Japan, we're getting a VAT cut at a time when actually Japanese inflation has been incredibly high. And, last year, Japanese nominal GDP was one of the highest in the developed world. So I would say we are just, it's not quite rational. Mm-hmm. And someone like Kevin Warsh really comes out and says that, actually fiscal spending does lead to, has consequences for inflation. So the real question for Kevin Warsh is, if President Trump does give the $2,000 checks to American households, will he then just go back to his orthodox roots and say, well, that's a fiscal expansion and we need to raise interest rates? That's what the Kevin Warsh of 2024 would have done. And, I'm not quite sure. His more recent comments, just are a little bit more nuanced, shall we say.
OK, that's very diplomatic. Well, what do we know about China and how they're buying up commodities? Again, I don't know whether there's this big flare-up between the US and China because of what's happening in the oil market, or whether the two countries have found a way forward.
Let's put that in the context of oil. Oil has probably been much stronger this year than people expected, and I think that reflects a few things. It reflects that, as we've just discussed, the global economy is growing quite well, and that is supportive for oil demand and oil prices. And it does obviously reflect some of the geopolitical risks in the world. We've had a big bounce in oil prices this week because of the potential for US military action against Iran, but it may also reflect that China has been taking advantage of this relatively weak oil market to augment its oil reserves and to really make sure that it has the scale of oil reserves it feels it needs to protect its economy in these more uncertain geopolitical times. So I think that's an interesting insight into how Chinese thinking is playing into a major commodity market.
Subitha, your take on China? Is it a deflationary story because we're importing deflation, or should we really focus on AI, having these deflationary input without needing China to help?
So, I mean, China is so critical to the AI build-out in terms of supplying the components for the AI build-out. And, we can see its exports are growing, it's excess of 1 trillion. I think ultimately China is an incredibly deflationary impulse for countries that haven't put tariffs on China. So if you think about sort of Chinese prices, PPI, that's actually fallen quite considerably over the past few years. And if you think about Europe, its PPI has actually gone up. So Europe has lost dramatic competitiveness. Some people estimate 30% relative to China. So, China is gaining competitiveness across the world. And I think, in Asia, in emerging markets, China acts as an incredibly large disinflationary force. And I think the question is, what does Europe do, with its open markets?
Thank you both for joining us. Will Kennedy, Bloomberg EMEA News Director, and Subitha Subramaniam, Sarasin and Partners, Head of Investment Strategy. Coming up, more on the Fed, dollar and gold, with Patrick George, Global Head of Markets and Security Services at HSBC. That's next, and this is Bloomberg. So it's been another week of market-moving headlines, from colossal AI spending to the EU-India trade deal, and of course President Trump saying he'll announce his Fed pick over the coming hours. Now, it's triggered another dizzying week for the dollar, gold and commodity markets. Patrick George, Global Head of Markets and Security Services at HSBC, joins us now to put things into perspective and discuss what he's hearing from clients. Patrick, great to speak to you. Thanks so much for coming on. Tell me a little bit about how a lot of the clients are actually living through this volatility. I mean, it's not that the prices are going higher, is that there's just a lot more trading. Are people nervous? Are they trying to figure out what's happening? Or is it just opportunities?
No, for sure. I mean, it's been a very eventful couple of years, driven by many events. And if you had asked me 2 years ago what are the top emerging risks that are keeping everyone worried, I would have told you geopolitics, geopolitics, geopolitics. We're getting into 2026. We add to this another layer of local politics. So everything is there. All the ingredients are there to make the market move one way or the others. And we've seen it across all asset classes. So yes, we've seen the rise of commodities. We've seen the rise of equities that are ignoring all the risk at the moment. We've seen volatility in the bond market. We've seen very tight spread in the credit market. Again, that made it so far a very strong market for investors. But yes, the markets are nervous, the markets are volatile, and investors at the moment have been ignoring all the emerging risks.
Yeah, so what do you see as emerging risks?
Sorry?
What do you see as the main emerging risks?
The main emerging risks at the moment is the uncertainty on data, economic data, continuous geopolitical tension between China and the United States, tension between China and the West, local conflicts, regional conflicts, like the one in Iran, how this could fold, the next pick of the Fed, the independence of the Fed. All those will be, if you want, questions that investors are trying to ask at the moment.
Patrick, when you look at the markets, is this the new normal, that we're just going to have a lot more stress, a lot more risks out there? Or do you see a period of kind of instability as we try and figure things out and then leveling off?
I think that has been the new normal for the past 3 years. That we've seen a period of tension and period of pragmatism, but overall, the onslaught of events, the onslaught of news has been there, and I think 2026 will be an eventful year.
What does it mean for what your clients want? What do they ask?
The clients ask for ideas all the time. They ask what are our top ideas, what are our views on the market. I think the clients have been enjoying the volatility. I think the clients have been enjoying. We've seen massive shift in asset allocation recently in 2025. I think we are poised for more asset allocation changes in 2026. But at the moment, the clients have been riding the market. They've been ignoring the news. They've been ignoring the fiscal imbalances we've seen in the market, as your previous host has said. So I do believe we need to watch very carefully the next phase.
Does the dollar weaken further from here? And again, do you have to just diversify your portfolios a lot more?
Look, the weakness of the dollar has definitely been a trend there for the past 12 months. It's been driven by many things. It's been driven by geopolitical uncertainty, the uncertainty about tariffs. It's been driven also by diversification in foreign exchange reserve. So I think the dollar trend, we might see a correction because it's been very sharp in the past few weeks and in the past few months. But I think the trends overall is there for a dollar week in 2026.
I mean, how do you again balance the the value of the dollar, but also giving yourself the means as the U.S. to service a long-term debt?
Look, the fiscal imbalances has been there. It's a big question. It's a big question on everyone's ask. It's not just about the U.S. It's about also Europe. Europe is embarking on a massive transformation, from a structural transformation, infrastructure spending, military spending. So there is a lot of question mark on fiscal imbalances in the UK, in France, and in Europe, generally speaking. So is in the US at the moment. This is being reflected in the price of gold. I mean, despite the correction today, which was probably warranted after such a sharp rise. But yes, the uncertainty about fiscal are definitely waiting on the bond market. I do believe we will be flirting with the danger zone of 5% when we go above the 20 and 30 years. So we should be watching very carefully the treasury market.
Patrick, I mean, there's been quite a lot actually in terms of trade deals that I know have been years in the working, but that we found out about them in the last couple of weeks. It's Mercosur, it's India. Do you expect that to benefit your clients, or do you expect to grow in some of these markets?
Yes, it's a very good question. Look, the uncertainty and the geopolitical tension, the uncertainty between China and the US, the uncertainty, generally speaking, has opened new opportunity. What we have seen over the past few years is an emergence of new corridor of trade, which led to new corridor of finance and new transaction there. What we've seen over the past few years, pre-COVID, and it has accelerated with COVID, it has accelerated also with the tariff uncertainties we had last year and liberation there, but we've definitely seen an emergence of new corridor of trade. Yeah. We've seen new corridor of trade between China and the Gulf, between China and Southeast Asia, between India and the West. We're going to see more new ones. And this is new business. This is good business. No. We have evidence also. If I look at our own business at HSBC, we look at our Singapore and Taiwan office 5-6 years ago. We used to trade 5 currencies with corporate. Today, we trade 18 currencies. This is not speculative trading. This is on the back of real corporate activity among countries in the region.
So where does it mean that you see the most growth in terms of, within your unit? And does that mean hiring? Like, how do you see opportunities?
No, look, within my unit, we see opportunity definitely in everything that is transaction banking driven. We see a lot of opportunity in our foreign exchange business. As we see the emergence of those new trade, this new corridor of trade and finance, we will definitely see emergence and growth in our foreign exchange business, in our security service business, in our trade finance business, in our payment business. All those will benefit dramatically from this new emergence of corridor of trade. So yes, what could be seen as geopolitical risk could be exactly seen again as some opportunity, business opportunity, and that's how we're looking at it.
So interesting. Patrick, thank you so much. Patrick George there, a global head of markets and security services at HSBC. Now, coming up, Euronext sees the impact of stagnating capital markets. We'll also discuss the outlook for new listings with the chief executive. Remember, it's a big day today. We were hoping for a quiet Friday. Well, some of us were hoping for a quiet Friday. It could be an epic Friday. The Trump administration preparing for the nomination of the Fed. We understand through our sources that the president is ready to nominate Kevin Warsh to be the next Federal Reserve Chair. More on that shortly, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump says he'll name his choice for the next Fed chair today. Bloomberg understands Kevin Warsh is set to win the nomination. Strong demand for the iPhone 17 helps Apple to deliver record quarterly sales, but there's a warning that rising costs could eat into margins. Plus, a 1-hour delay to the start of trading on the London Metal Exchange causes confusion amongst traders, capping a week of intense volatility. Now, for the first time since Euronext's own initial public offering more than a decade ago, companies raised less than $1 billion through IPOs across its exchanges in 2025. But the year is off to a positive start after the IPO in Amsterdam by armored vehicle and munitions maker CSG. Now, we're joined by the chairman and chief executive of Euronext, Stephane Boujnah. Mr. Boujnah, thank you so much for joining us. First of all, how is Europe doing in terms of listings in general? There seems to be this proxy fight fight between Europe and the US in terms of capital attraction? Who's winning?
Well, on the IPO side, it's clear that the beginning of the year is amazing. I mean, as you've just mentioned it, Czechoslovak CSG Group has launched its IPO last week in Amsterdam on Euronext for something like a 25 billion market cap. Today it's more than 30 billion. They raised 3.8 billion. I mean, we are starting the year with a lot of energy. We have around the corner the IPO of KNDS, the Franco-German military equipment manufacturer. So on the defense and aerospace sector, clearly there is a strong momentum. Kongsberg in Norway is going to organize the IPO of their maritime division. And we have more of these aerospace and defense companies in the pipeline. So I believe 26 will be a great year for Europe.
Yeah. So do you think Euronext is actually presenting itself almost as a hub for defense company listings?
Yeah, we have been committed to what I call the new ESG, energy, security, geostrategy, through various products with a specialized defense bond segment, with IPO-ready programs for the non-listed aerospace and defense companies, because on defense and aerospace, Europe needs speed and scale. And scale requires consolidation and requires access to global markets.
Are you doing anything specifically to encourage these listings in Europe?
Absolutely, absolutely. We have a dedicated program. We have a fundamental vertical for aerospace and defense that starts with non-listed companies, with helping them to raise equity funding when they are not listed, through helping them raising debt, helping them getting access to public markets, and making through all sorts of indices to what I call new ESG, energy, security, geostrategy index, getting more visibility to those companies.
So we mentioned, of course, CSG as Euronext's first big listing of the year. What else is to come? Are you expecting more bigger IPOs of that size?
Absolutely. I mean, not necessarily of that size, but clearly in the aerospace and defense sector, we are expecting a sustained flow, because those companies...
How many, like 10, 15?
No, I don't want to make numbers. I mentioned the ones for whom the decision is already public. I mean, the companies themselves make public their plans. But I can tell you that the pipeline on aerospace and defense is unprecedented.
What went wrong last year? Why were there no big IPOs?
I think when markets are too volatile, when markets are uncertain, people don't take the boat. You need enough volatility for volumes to be there, but you can't stand extreme volatility if you want to go public. What is true, though, is that there is a new interest for Europe from the rest of the world and from US investors. US investors and the rest of the world finds valuation in Europe cheap and not necessarily justified by the gap between growth prospects in the US and in Europe. Second, they find the US a scary environment, unpredictable, with too much volatility on decision making, too much uncertainty on rule of law, too much uncertainty on tariff, too much uncertainty on interest rate, too much uncertainty on inflation, too much uncertainty on fairness of business relationships. So people around the world, in particular in Asia and in the Gulf, say, whoa. Let's diversify away from the U.S. risk, because the U.S. is not what it used to be. So the rest of the world is mourning and grieving the U.S. because the U.S. is not recognizable. And therefore, we see for real, and asset managers can confirm that, a new flow of money from the rest of the world, looking at Europe differently, as maybe lower return than some emerging markets, but lower risk as well.
Stéphane, do you actually have numbers for that? Because because of the Magic 7 or the Magnificent 7 in the US, actually valuations are pretty strong in the US.
Well, if you do, what you have to do is to neutralize US markets from the Magnificent 7, because the Magnificent 7 are great companies, but they are in fact global tax collectors. They have a price-making position that allows them to be in a different league. And therefore, if you neutralize the US market from those 7 companies, and when you compare performance of the rest of the US list with Europe, when you look at the gap in valuation, and when you look at how investors behave, you can look at, beyond valuation, fundamental moves in terms of flows of investment, of money from the rest of the world and from the US that look at Europe differently. Because there are Europe, in average, European companies are much more global and are capturing much more of the diversified growth across the planet than companies of the same size in the US that usually are more local.
Yes, but if they're very exposed to Europe, there's concerns about competition. I mean, this is what I hear from everyone.
What I'm trying to
Europe needs to get back.
No, but what I'm trying to underline is that large European companies are much less exposed to their domestic markets and the European markets than large global companies in the US are exposed to the US dynamic. Large European companies are global companies because they have to do it to survive. Look at some great countries like Italy that has a massive and amazing commercial export surplus. So that's the strength of European companies. They are global, and that's why they are attracting more appetite from global investors, in particular those days where everyone is on a pause mode vis-a-vis what is happening in the US, which is like mourning or grieving. You are shocked, you are in a state of denial, sadness, anger, and then hopefully acceptance and reconstruction. But really, people are in a state of mind where they don't know what to do with the current US environment.
You've just completed the acquisition of the Athens Stock Exchange. What's next on your list?
Well, Euronext is an open house for consolidation of European players. We are more than enthusiastic if we are approached by anyone who wants to join our open project. Euronext is the living proof that either we succeed together or we fail separately. And what we have built, a single liquidity pool, a single order book, an equity market, which is now twice the size of the London equity market. Every day we trade 12 to 13 billion euro of volumes, which is more than twice the size of the equity market in London. So this is the place to be for the ones who want to build European strategic autonomy.
You're very optimistic about Europe, which is great to hear, but is there anything that frustrates you? Is it regulation? Is it something that's slow? Like, what could we do better?
Europe needs speed and scale. And we need to revisit completely a framework, in particular on antitrust, that was invented in the 50s, in the 60s, in the 80s, when China was not a superpower and when US was a fundamental partner to Europe. In a situation where we get to a new world where China is here and where the US is not necessarily a structural partner, then we need to have a different approach of consolidation. Europe needs speed and scale. To get speed, you need to invent shortcuts, and to get scale, you need to accept consolidation and creation of European champions.
I mean, last year there was a lot of talk about this unified European exchange. Did any government or the Commission come and talk to you about it?
No, there are talks. I mean, a few days ago there was a meeting between the French Minister of Finance and the German Minister of Finance, where they shared views about what they can do to create more liquidity for scale-ups in Europe, and they shared ambitions that one day we can build something together. So there is clearly an appetite and interest at the government or leaders level to make things happen. Now, this is one thing. The other aspect is whether the corporates themselves who run the assets, who own the assets, are willing to embark into this type of consolidation. As far as Euronext is concerned, the purpose of Euronext is to be an open vehicle to create the strategic autonomy of Europe and to make Europe strong when it comes to financial markets.
Stéphane Boujnah, thank you so much for joining us. That was, of course, the chief executive of Euronext. Now, lots of challenges we've just been discussing are also being faced by Sweden's most powerful business dynasty, which is also facing a succession drama. After more than a century of tightly held control, the Wallenberg family is quietly elevating a younger generation with influence across nearly half the country's stock market. It's raising questions about power, privilege, and whether the $40 billion empire can modernize without losing its grip. Well, I sat down with Peter Wallenberg Jr., one of the three men leading the family in Stockholm, for an exclusive conversation about managing change and volatility.
We will be around because I think that we need to do this together because the world is changing and the challenges are growing every day. We wake up every morning not really knowing what will happen from now on. And those are questions that we need to work with together.
How do you think the world is changing?
I think that all the questions that are coming out of North America right now is, of course, changing. The war in Ukraine, the Middle East, all of this that we, in our generation, haven't had in the same sense. We've been spoiled. There has not been that many conflicts of this magnitude at the same time. So I think that everything is very new for all of us. And we need to understand and help ourselves and the companies around us to work in a new reality. As I say, I think we need to be more of a group working. It's not on an individual basis. It's something that we do with the people around us, with the companies, and as a family.
You clearly love research and universities and kind of big thinkers.
Yeah.
I mean, is this a big advantage for Europe that Europe should and could commercialize better to maybe counter some of the big companies in the US?
I think that yes, we have to. We have been too reliant on others, and to be honest, I think that it is proven that we do have a lot of know-how, both in countries like Sweden, but in Europe at large. And we need to find ways of working much closer with each other. We have to get away from mine is mine and yours is yours. We need to find ways of working together, because we have different competences and different know-how, and we need to put that together to show that Europe can be part of the world in that sense. We've shown here in Sweden that getting academia and business to work together to see to it that we, as a small country with limited resources, can develop and find ways of developing ourselves and the competence within our country. And I think that we could do the same on the European level.
Is there a setback in Europe because there's not enough capital? I don't understand what the missing link is, actually, compared to some of the big American companies that do so well.
Of course, it is difficult to compete with the big American companies. But if you take Silicon Valley compared to Europe, yes, they are ahead of Europe, but does that mean that Europe doesn't know anything? Of course not. I mean, there is European companies that are doing very well, and a lot of small startups that are extremely exciting, but all the funding is still going to Silicon Valley. So, we have to help to find ways of seeing to it that we actually lift what we do have and use it in the right way.
Talk to me a little bit about how you see a lot of the technology space changing. I know Investor AB is a big investor in Ericsson. Do you worry about just job displacements?
I think that technology that we're seeing, the change in technology, will of course make changes in how different industries work and what it means for employment. I think it is a challenge. We as owners started many years ago talking to our companies about their responsibility in the time of change, knowing that AI and other technologies would be part of their development. We talked a lot about future-proofing. Yeah. Where are you going to be in 5-10 years? What does that mean, not only for your companies and the products that you produce, but also for your employees? It is up to you to already now start to try to find ways of re-educating, because it's not that all jobs are going to disappear. It's just that we're going to need other types of jobs. So, and we all need to be part of that change and take the responsibility in that change.
That was Peter Wallenberg Jr., and you can watch more of that interview and read more about the family's transition on the terminal and online. Coming up, we'll discuss the latest successful funding round for business AI firm Uniphore. The chief executive and co-founder Umesh Sachdev joins us next. This is Bloomberg. Everyone. Now, next week, NASA is planning to return to the moon for the first time in more than 50 years. 4 astronauts are due to blast off on February 6th to conduct a 10-day flyby of the moon. The mission, named Artemis 2, is expected to confirm that the Orion space capsule works as it should in deep space. Well, Bloomberg Originals has been taking an in-depth look.
I think our generation appreciates having a program that now we get a chance to take our own moonshots, what we call great things that humans accomplish
NASA's Artemis program is the space agency's ambitious mission to send humans back to the moon for the first time in more than half a century. The last time NASA sent humans to the moon, they were locked in a space race with the Soviet Union. This time, NASA wants to go back to the moon to stay in order to learn how to live sustainably off of the lunar surface.
4-stage engine start.
Prior to Artemis 2, NASA launched the very first major mission in the Artemis program, called Artemis 1, which sent the Orion crew capsule around the moon to demonstrate that they could work without a crew on board. Now it's time to show that they can actually keep a crew alive while traveling to deep space.
Our goal is get to the moon and get back. 4 days out, 4 days back.
We are going to do as much science as we can on the way. And on the far side of the moon, we're going to have maybe 45 minutes where we're in a loss of comm with Earth. And all we can do is just train our eyes on that moon surface.
The entire Artemis program has come under significant criticism for how much time it's taking to build and how much money it's costing the taxpayer. There is an estimate that between 2012 and 2025, the Artemis program has cost roughly $93 billion. Despite the criticism, it does benefit from strong congressional support. Many of the programs that are needed for Artemis are spread across the entire United States and provide a lot of jobs for constituents. While the Artemis 2 mission is coming up, Artemis 3, Artemis 4, Artemis 5 are all a bit of open question marks at the moment. There's development that needs to happen for hardware, notably with the landers that will actually take the humans to the surface of the moon. NASA is pulling out all the stops with its contractors to ensure that a landing occurs no later than 2028, but it remains to be seen if that date will actually be possible.
Well, subscribers can watch that mini doc on the Bloomberg terminal. Now, some of the biggest names in AI and data have taken part in the latest funding round of U.S. business AI firm Uniphore. The company raised $260 million, and we're delighted to be joined by Umesh Sachdev, the co-founder and chief executive of Uniphore. Umesh, thank you so much for joining us. I mean, I have a million questions on actually what customers want now. And you've been on this trip, you were in Davos. Now I understand you're doing some of the European capitals to speak to customers and clients to understand their needs and wants. What are they asking?
Well, great to be with you today, Francine. You're right, last week Davos, this week in France and now UK, probably met about 50 CEOs, CIOs. And the big theme I'm picking up, especially in Europe, is sovereign AI. Customers in Europe, big telecom companies, big banks, are very thoughtful right now of having, quote unquote, their own AI, with some customers even saying President Trump is the biggest salesperson for sovereign AI architectures. Now, at Uniphore, we sell a sovereign and open data and AI platform, and that's why customers are talking to us. But this is a theme that's becoming louder every week now.
So what LLMs are customers demanding the most now? Are you using Chinese models or are you using Mistral? And how will that change?
Well, two of our biggest markets are North America, US, and Europe. In US, Gemini, Anthropic, OpenAI are still in the lead. Some of the biggest regulated businesses even telling us that don't even talk about Chinese models. We believe, our developers believe those models are phenomenal, but our customers are not ready in the US. In Europe, I see a lot of Mistral, I see a lot of Anthropic, etc. But here's the thing. Customers are realizing that switching cost between LLMs is trending to zero. Last year, it was about, my customers were asking me, what's the latest model? What has Gemini done? What has OpenAI done? This year, customers are beginning to realize, listen, this changes every 6 weeks and everyone's catching up. So let's actually start talking about what's the real business outcome that AI would deliver as opposed to what's the latest LLM.
So you're also, I understand, working with KPMG. Is that right? What do you make of the future of consulting?
Well, in Davos, we announced a big strategic collaboration with KPMG. Had you asked me this question last year about big consulting, big system integrators, I would say I'm worried about their future. What I'm beginning to realize, what's changed, is both those firms now have a solid strategy. But like I said, the customer conversations, we serve over 2,500 customers at Uniphore, big banks, big telecom, big retail. The conversation is shifting to outcomes. And firms like KPMG, in partnership with technology providers like Uniphore, are putting themselves in a position to deliver what's being called outcome as a service. Which is to go to a client and say, let's not worry about which GPU versus CPU, which LLM of latest generation versus older, which agent. let's actually focus on which business process you want to optimize with AI agents, and we'll deliver the entire thing on an outcome as a service model. And that's where these consulting firms are almost feeling a resurgence, and relevance is back to them in this agentic world.
Look, and that's, it kind of encapsulates some of the big questions that we have, but there's also a lot of, I guess, concern about valuations on AI firms. I know in Europe we spent a lot of time looking at SAP. It lost some 39 billion euros in market value because it was disappointing financial results. I mean, do you follow things like this? Does it help you decide what happens next, or is it just market moves that interest you less?
Yeah, I mean, as you would imagine, this talk of AI bubble is almost deafening. It's been for the last several months. Just yesterday, Microsoft announces earnings, misses its growth. Instead of 39%, does 38%, and the stock's down 10%. So from my vantage point, I don't see an AI bubble. Are some private valuations in Silicon Valley exuberant? Sure. But that always happens. Each time we see internet or Bitcoin or cloud or SaaS, any new trend, VCs tend to get ahead of themselves and, overfund some early stage companies, out of which emerge some winners and some won't. This is the typical Silicon Valley model. But if you look at public companies, NVIDIA's price to earnings, NVIDIA is a very cheap stock to own right now. Microsoft, over 100 billion of cloud revenue, growing at 38%, missed its growth projection by 1% point. I think we all need to take a deep breath. We are in very early innings of a $5 trillion market opportunity, and we're just in the build-out phase. So from my vantage point, the bubble fear isn't very well-founded right now.
What are your plans for the company? Do you plan at some point to IPO?
So look, we raised our Series F round, which you mentioned, $260 million at Uniphore, with NVIDIA, AMD, Snowflake, and Databricks investing in our financing. Becoming a public company is an attractive proposition to both me and the team. But right now, as you know, as being a company headquartered in Silicon Valley, the U.S. market for tech IPOs has been shut mainly for the last 4 years. I am very bullish that we're going to see some big ones, big IPOs this year. There are companies like OpenAI, Anthropic, Databricks, Canva, which are in the pipeline. And if some of them go in 2026, we're going to see those markets open. We're going to watch the performance, and right behind that, we're going to start to make our own plans of IPO.
Okay, Umesh, thank you so much for joining us. Umesh Sachdev there, a co-founder and chief executive of Uniphore. I hope you come back anytime you're in Europe. A reminder of our top story this morning: Bloomberg understands that the Trump administration is preparing to nominate former Fed Governor Kevin Warsh to be the next chair of the Federal Reserve. Now, President Trump has said he will make a formal announcement later today. If confirmed, Warsh would succeed Jay Powell when his term ends in May. We'll have, of course, full coverage throughout the day here on Bloomberg. Now, we also have an exclusive interview with the Fed Governor, Stephen Marin, at 8 p.m. London time. Again, that will be a really good conversation when it comes to inflation, but also productivity expectation. It's very clear that the market are taking the possibility of Kevin Warsh as becoming Fed chair as maybe a bit more of a hawkish. Investors see him less supportive of deep interest rate cuts, although in recent months he's really aligned himself with what President Trump would want to see. Now, European stocks still up, gold sliding 7%, the dollar advancing. Again, a person familiar with the matter told us that the former Fed governor visited the White House on Thursday, and we are expecting an announcement shortly. This is Bloomberg.